The session on where is the funding come from will now begin. May I first invite Mr. Mark Clifford, Executive Director, Asia Business Council, Mr. Benjamin Hong, Executive Director and Chief Executive Officer, Standard Chartered Bank Hong Kong Limited, and Mr. V. Paul Lee, Managing Partner, Vanedge Capital Partners Limited, to proceed to the stage.
Good morning, ladies and gentlemen. I'm Mark Clifford from the Asia Business Council, and I'm delighted to be the moderator for the final session of the morning. I caught the end of the last session, and it seems that you're an extremely enthusiastic, energetic audience with lots of questions. And since we're starting on time, we'll have a full hour to listen to two very distinguished speakers talk to us about the financing side of things. You heard a lot about entrepreneurialism this morning, but entrepreneurialism isn't just about passion, it's also about money and having the finance to realize your dreams and your passion. What we'll do is start off with presentations from each of our two distinguished guests, and then we'll have the remaining time for Q&A. I think you're both familiar with the background of Ben Hung and Paul Lee, but briefly, Benjamin is the chairman, the CEO and executive director of Standard Chartered Bank Hong Kong. Ben was born in Hong Kong and returned here in 1992, just when things were, I think, really getting started in terms of the Hong Kong economy, and has been with Stanchart ever since. He's involved with a number of other bodies in Hong Kong. He's vice chairman of Hong Kong Association of Banks, involved with TDC, the Airport Authority, the Exchange Fund, I believe, and a number of other very important financial institutions in Hong Kong. So, Ben, if I could invite you up on stage. Thank you.
All right, good morning, everybody. And first of all, thank you. And I must say thank Vincent for inviting me to come and speak. He rang me a few months ago saying you have to come speak. And when Vincent rings you, you have to duly obey what he says. So here I am, but wonderful to see such a big audience. I think first off, I must say SMEs play a very, very important role in any economy around the world. In most of the high-income geographies, obviously, Hong Kong being one, more than half of that economy's GDP tends to be derived from the SME. And from that, obviously, it's always a very, very big employer. Again, here in Hong Kong, I think more than half of the private sector employment comes from SME. And to me as a banker, nothing is more gratifying to see an SME to be able to help see it grow, nurture it, develop it, and hopefully blossom into a very, very large corporate and hopefully even becoming an MNC. I don't know about you, but I like ice cream. And Häagen-Dazs was literally born only 50 years ago as a couple selling 3 flavors of ice cream on the back of a horse-drawn cart. And it's definitely started with very, very small beginnings. I think ditto for, I would say, IKEA, which really started with one store for the longest time in Sweden until the 70s, where it started to expand internationally. And I'm sure most of you would agree, our local, one of the most prominent local businessman, Mr. Li Ka-shing himself, has had more humble beginnings. So all these stories, all these successes, I'm sure all of them have gone through a lot of winding roads with a lot of partners along the way helping them succeed. And I hope that one of those partners will be your banker. And obviously there are always a lot of criticisms, myths about banks. Usually they are heartless, they are soulless. They take away the umbrella when the rain starts to fall, and so on and so forth. And I thought it may be a good idea for me to just share with you what's on the mind of bankers, so you know why we behave and what sort of animals we are. Of course, we love to deal with large corporates like a Shoyon, like a Jardines, etc. But I would equally say SMEs are an equally important part of the banking business. It represents a very, very significant portfolio within a bank, and definitely for me here in Hong Kong. You need to understand, firstly, that bankers are in the risk business. That's a starting point. And bankers don't like bad debts. Fair? I think that's only a fair starting point. And the harsh reality is most SMEs don't quite make it in the first 5 years. I think roughly half of SMEs don't quite make it through the first 5 years. So for the purpose for the avoidance of bad debts, bankers basically look at two things. One is the ability to repay, and the second one is the willingness to repay. Let me just touch upon these two things very, very quickly. Firstly, it's on the ability to repay. Obviously, there are two issues that the bankers deal with. One is the asymmetry of information. Large corporates, listed companies, they all have very, very transparent, audited balance sheet, P&L, cash flow statements, total bank borrowings, et cetera, et cetera. For SMEs, I think the challenge and the issue for banks are, first, they have less information. The information are less perfect in the sense of they could be unaudited, et cetera. And obviously, a lot of knowledge, a lot of information are really held in the head of that owner, that entrepreneur. So the information is one aspect. The second aspect of the ability to repay rests with the predictability of cash flow. This is very, very important. And banks always look for steady cash flow. That's the predictability of the ability to repay. Obviously, again, when you're more established, when you are bigger corporates, when you have more lines of business to diversify, your cash flow tends to be steadier. And for smaller businesses, that tend to be a more volatile area. And to be able to ascertain the stability of cash flow is one aspect that the banks need to do. Where these two factors, i.e. the information and the predictability of cash flow, doesn't quite get to where we need to, I think that's where usually bankers will require a higher return to compensate for these risks. And where singularly return, just to use a return or interest rate, can't fully accommodate these risks, that's when bankers will ask for collateral. I just want to make it very, very clear. Collaterals to banks are at best a supplement. It's never a primary reason why we lend or don't lend. Very often times, there are customers who come to us, hey, I have a property, I have whatever, can you lend me some money? Chances are we'll say no. Because what we need to know is, what is your business? What are you using the purpose of a loan? What are the cash flow projections for that? That, to a bank, is far more important than purely having a piece of brick and mortar. So that's one aspect. The other aspect, as I mentioned, is the willingness to repay. And to me personally, that is as important, if not more important, than having the ability to repay. Call me an old-fashioned banker, but a handshake to me or a look in the eye is a sign of a commitment to honor an obligation. That is reflective of the individual's trustworthiness, that individual's integrity. And that, to me, is far more important than simply having a strong cash flow, strong balance sheet. And relationships between an SME and a bank needs to be built over the years. That is, I think, something that I just want to bring to your attention in terms of what banks do look for in whether to grant a loan or not. So then you might say, what might the tips be from me to you if you want to engage with a bank? There are a few things. One, I would say, is help bridge that information gap. Help bridge that information gap. And you need to make sure that communication lines are very, very open with the bankers. I think most SMEs that I deal with, they tend to be very, very wary or very, very cautious about giving information for fear that banks will do something drastic, will knee-jerk, may pull lines. And I think the starting point you need to agree with me on is bankers do want you to survive. If you don't live, there will be no repayment whatsoever. So the starting point is banks do want you to survive. Banks don't want you to pull lines so that you have a crunch and you go bankrupt. So that's the last thing bankers want to do. And you need to share with the banks your plans, your projections, what you intend to do. And a responsible banker will give you good advice and will also let you know what's workable, what's not workable, when it becomes overly stretched, that you need to be cautious of. And bankers hate surprises. And whenever there are surprises, banks tend to knee-jerk. That's the worst thing to see happening. It's bad for banks. It's bad for customers. So try not to give surprises, even if that means you tell a bank that, look, next month's due date, I might have problems. Can we do workarounds? Can we do just interest and perhaps term out the loans? Bankers would be more than happy to, provided you share your problems early enough, I think banks will be more than happy to help you weather through difficult periods. The second one is make sure you show good discipline and governance. And with that I mean make sure that you segregate your finances between your personal expenses with that account of the corporate. I see a lot of people just completely mingle, having the corporate account, pay off their personal credit card and et cetera, et cetera. You're not helping the bank if you do that, because the bank is trying to assess the viability of the business, not how much you spend on credit cards or how much you drink over the night, the lan kwai fong. So that's one aspect you need to make very, very clear. The third aspect is make sure you match your funding purposes between short-term and long-term. Many SMEs use short-term financing to fund long-term projects. That's not a good idea, to the extent that if the short-term liquidity doesn't count, gets crunched, your long-term projects will be at risk. Flip side is also true. People sometimes also use long-term funding to finance short-term working capital needs. That's, to me, it's very, very inefficient. So make sure that when you do, for trade, for example, you do your working capital short-term loans, and for longer-term plant, equipment, investments, et cetera, then you do term financing. And final bit is, I would say I encourage all of you to be open-minded about exploring different forms of financing during different stages of your SME's development. It can go from equity, it can go to private equity, which Paul will elaborate on, bank financing, factoring, government guarantees. All these are different forms of financing you can have access to. Be open to them. Okay, at different points in time, you might need different sources of financing, which actually leads me to one point about the government. I think obviously banks are very, very keen to support the development of SMEs. I think the right level of government support at the right time can prove to be hugely, hugely beneficial, especially during challenging economic periods, particularly through a down cycle. I think a case in point would be about 2.5, 3 years ago. I think the government was very, very quick to introduce the SME loan guarantee scheme back in 2009, and literally within 2.5 years, Hong Kong is at its full employment. a lot of these has got to be the ability to support SMEs, particular liquidity needs during the most difficult periods. And I think that's something that I think we should all learn from, particularly for those of you coming from geographies. That's something that government can play a very, very important role. My final bit of message would be banks or banking is more of an art than a science. And banks or bankers are humans, and businesses are done through human relationships. All these are done through human judgments. So this is not a cold science. A lot of them revolves around, again, knowledge, communication, relationship. Bankers are very, very keen to be your trusted partner, and I think bankers would be among those who are most keen to help and see you succeed down the road. Thank you very much.
Well, thank you very much, Ben. It's very refreshing to hear an old-fashioned banker, as you say. We haven't always heard enough from traditional bankers in the last decade or so, and I think people often forget what banking's all about. You said something I thought was quite interesting, which is that the most important thing is integrity, that a handshake, looking someone in the eye really counts. What should our audience think about when they're trying to impress their bankers with integrity, and how do you judge that?
Mark, that it comes back to the very point of it's a human judgment. Okay, I see a lot of cases where corporates do have the ability to pay, but when they don't want to repay, there are a lot of tricks that they can do to get around that. And that's why I said very upfront, the banks or the bankers will need to assess the integrity, the professionalism, trustworthiness, the honesty of an entrepreneur. There are no hard and fast rules to assess that, but that comes through with experience, with that belief that if somebody is keen to honor its obligation, it will always find a way to honor that. And that, to me, is far more important than just purely looking at numbers and spreadsheets.
Well, I think you must be doing something right, because I think all of us who followed Standard Chartered in the last 20 years, coincidentally since Ben joined, we've seen a very nice run for the bank. So you and, I guess, first Mervyn Davies and subsequently Peter Sands and the rest of the senior management team have done a great job at the bank. We'll get back and we'll have a chance to ask Ben more questions, but I'd like to invite Paul Lee up to the stage. Paul is the managing partner of Vanedge Capital, based in Vancouver. Paul is also one of three Canadian representatives of Apex Business Advisory Council. Paul started Vanedge in October 1st, 2008, a week or 10 days after a bank called Lehman disappeared from the face of the earth. Interesting time to start a venture capital fund. Paul is a finance guy, but with a very heavy background in digital media, and that's what the firm specializes in. Paul was very involved for over a decade as president of Electronic Arts, which was one of the great, I think, software and game success stories of the 90s and beyond. So, Paul.
Thank you, and thank you very much, Vincent, for having me here. It's an honor to be here, and I'm amazed at how many people. This has got to be the biggest audience I've ever seen for one of these summits, so great work to you. Well, let me start by talking a little bit about entrepreneurship, because there's really, what we do as venture capitalists is really to support entrepreneurs who actually create the businesses. Without the entrepreneurs, we really don't have something that we can do. And within that, I think as you go from conference to conference, one of the things that you constantly hear about from entrepreneurs is a theme of common issues that we hear over and over. First of all, it's networking. The ability to meet and share ideas. There's the access to markets. How do I find a market for my products? There's recruiting. How do I find great people? There's how do I build a sales and marketing organization? I've got this fantastic product, but I don't know how to get it to people so that they hear about it and want to buy it. There's the whole information needs of how do I build a business? What should I be doing? How do I build a business plan? How do I talk to a bank? And inevitably, it gets back to financing. And one of the common themes is financing. And as Ben had said, there are multiple places where one can get financing as an entrepreneur. Obviously, their governments understand how important SMEs are, and so there's no shortage of government programs. From here in Hong Kong, Young Business Hong Kong, in Peru, from every country, there's innovative things that they're trying. Cher had mentioned, credit guarantees by the government in Chinese Taipei. China talked about getting banks to be more involved in lending for SMEs. Peru is doing something with Alibaba in order to put an e-commerce websites up so that small businesses can find and sell into the global marketplace. All of these things are critical, and what I will tell you is that when you get down to it, if you can get any type of government support or government help in your SME, you should take that. The second part that most entrepreneurs will look for is friends and family. And in our business, we call it the 3 Fs, friends, families, and fools. But you should take that as well, because friends and family are going to want you to succeed. They are investing in you specifically, and they are going to care about you succeeding. The third area is bank financing. And bank financing, again, they provide you the leverage. So if you have a stable business, if you have the ability to get financing, my general point of view is you should take it. And even if you were to talk to a VC, they would be more impressed with your business if you are able to obtain bank financing. So it does help you. What we deal with is the fourth one, which is venture financing. And so let me talk a little bit about what exactly is venture capital. At the end of the day, venture capital is nothing more than equity financing. We are not financing, we are looking to be your partners. When you talk about Islamic financing, there's a lot of similarities. We don't charge interest. We're looking for a portion of the company, a return, a share in the profits. And we usually do take significant control over many of the company decisions. So it's something you need to think about when you approach a venture capitalist. They're not going to be looking for, a passive investment per se. And one of the things that we do talk about is your ability to maintain control and your ability to be sort of independent rests on how well you do. So if you're doing well, you earn the right to continue to run. If you don't, the venture capitalist firm will focus on the company in and of itself first and foremost, and the employees in that company second. They tend to worry about the other investors last. So, now why do people then go to venture capitalists? Well, first of all, generally, bank financing is not available. The company has no collateral. There's no revenue. There's no operating history. Basically, it's highly risky. And what venture capitalists do is they invest in businesses that have that significant risk. And when I'm talking about venture capital, I'm really going to be talking about institutionalized venture capital. Most of the venture capitalists focus in key areas. I think you heard a bit about that from our professor here, about the areas that they will focus in because they think they understand that part of the business. They also understand that most new businesses do fail. And if it's only 50% after 5 years in Hong Kong, it's really, really good. Because most places, it's much higher. And what we do is we develop tools. We develop tools really to assess people, and we develop tools for markets, and we develop tools to understand the business. We actually work on developing tools that we think are going to help the business. But let me talk a little bit about the size of the market and what exactly it is. And what I'll do is I'll use the example, the U.S. venture capital market, just to put some numbers and perspectives in it. The most developed market in venture capital really is in the U.S. There are, according to the National Venture Capital Association, there are 791 firms. That's all. 791 firms that have raised money in the last 8 years. Over those firms, they've managed 1,183 funds. There are 6,328 individuals. or professionals who actually engage in this business in the U.S. In 2011, they raised $18.2 billion. So when you put that in perspective, Intel alone spends $6 billion a year just on research. So it's not a lot of dollars that are invested. And usually, as venture capitalists, they raise their funds, and it's on a 2 and 10, so they charge fees of 2% from their investors, and 2 and 20, and they take 20% of the profit, and their fund is around for about 10 years. Their goal is to invest the money over the first 3 to 5 years, and then hope that businesses grow, and then sell it in the last 5 years. In 2011, there was 3,673 deals that these venture firms invested in. That totaled $28.4 billion. But of those deals, only 1,139 of them, worth $5 billion, were for the first investment in a company. So when you think about around 20%, just a little bit over 20%, of the investment is in new companies. And there's only 1,100 companies. So most of the dollars are in follow-on. So when a venture firm invests in a company, note that they're thinking that they're investing not only in this round, but in the next round, in the next round, and the next round. The other thing to think about is that in 2011, the firms raised $18.2 billion, they invested $28 billion. In 2010, they raised $13 billion, and invested $23 billion. At some point, they run out of money to invest. So there is going to be an upcoming shortage. Hopefully that will change as markets improve. And in U.S., just as an interesting stat, 50% of the dollars are invested from California VC firms, 11% from Massachusetts, which is basically Boston, and 6% in New York. So why is venture capital, something that people engage in? Well, supposedly it is for higher returns. However, if you were to take the last 10 years and you take out the fees and whatnot, in the last 10 years, ending September 2011, the average return is 2.59% a year. That compares with 4.89 for NASDAQ, 2.82 for S&P 500, and 5.74 for government bonds. So realistically, investors who have been investing in venture capital over the last 10 years has not done well. Has not done as well as you would imagine when you hear about, and Ben joked about bankers being called heartless and soulless. You should hear the words about venture capitalists. If you take a 20-year scenario, however, the numbers change. And realistically, it's because of some of the problems we had in 2001 and 2002, the big crash, and it's some of the problems we had in 2008. But over 20 years, venture capital has returned 27.26%. NASDAQ 7.91, S&P 500 7.64, and government bonds 6.78. So on a 20-year basis, the numbers are dramatically different. And that gets to the heart of VCs having high risk and high returns, and that's really what they're after. But what do venture capitalists bring to the table? Well, besides money, what we really focus on is we bring networks of people, we bring understanding of the markets, we bring knowledge to your competitors. The average VC firm sees hundreds of companies for every one they invest in. The chances of them seeing most of your competitors are pretty strong. They also drive business advice, mentoring, and direction. And when a VC invests in your firm, when I join a company's board and we're an investor, about 10% of my time on that company board is actually in the board meetings. 30% is being a sounding board. We really try to be a sounding board, and we focus on the strategy with the CEOs before they get invested. By the time that presentation comes to the board, usually the management teams invest in that idea. It's really hard to change. So we really try to spend enough time to influence it beforehand. 30% of the time is spent recruiting. We spend a lot of our time recruiting for our portfolio companies. And about 30% of the time is focused on financing. As weird as that may seem, no matter what firms we invest in, it tends to be that we are constantly looking for increased financing to grow that company. And why is that? It's because we focus on companies that have great potential. On average, 40% of the firms that venture capitalists will invest in will fail, and they will have zero return. 40% of them will return something, some moderate amount. So 80% of the companies that venture capitalists in probably don't return their money back. What we're really going after is that last 20%. Those are the ones that we're expecting high returns from, that we're hoping will achieve 5 to 10x returns or much higher. What drives the portfolio for a venture capital firm is the fact that they're looking for high risk, high return, high leverage, fast growth companies. And that's why institutional venture capitalists tend to focus on the growth companies. They tend not to focus on the smaller mom and pop organizations. And how do we actually assess when people come in, and we do have people come in all the time, how do we assess the criteria of whether we're invested? Well, inevitably people come in and they present to us their product or their company, and they ask what we think. Here's the reality. The first thing we invest in is people, more than anything else. And when we invest, we tend to look at the presentation, we look at the people, and we may watch it. If we don't know you in advance, we'll probably watch you for 3 to 6 months just to understand who you are. We're looking for your past successes, we're looking for your skills, and your ability to grow a team. We don't really care. Anybody can be a CEO. It's the person who can rally the team around them and affect themselves to be leaders. And if you are a lousy finance person, just make sure you hire a great person. If you can't sell, find a great salesperson. But we're looking for the team first and foremost. Then we'll look at the product, and then we'll look at the market. But generally, we're looking for markets with high growth potential, and we're looking for products that can affect long-term leadership. The most important thing after that is the process, the company, how fast they adapt. No matter what you present us, we know that in today's world, it's changing so rapidly that whatever business plan you present will be changed in 3 months. So we're looking for your ability to adapt and react. We think that any firm that we look at, there's probably a competitor in every major city. And the last thing we're looking for is our ability to make a difference. If we don't know how we can help that company, we probably will not invest in that company. So last thing I want to say is there really is a role for government to play in this. There is a shortage of venture capital, I think, not necessarily in Silicon Valley, but in other parts of North America and in Asia. And here's why I think there's a role for government. There's a survey that was done about 2011 study on originally venture-backed companies in Silicon Valley. Recognized $28 billion a year, $25 to $30 billion a year represents less than 0.2% of GDP. Those companies have created 11.87 million jobs. They're 11% of all private sector employment. They're 21% of GDP and $3.1 trillion in revenue in 2010. So the dollars that venture capital has placed in the investments they have made to grow significant companies have made a difference to the economy. And it's an important part of the economy. And recognize no matter what VCs say, especially even in Silicon Valley, there's been no major VC industry that's been built up anywhere in the world that hasn't had government support to help seed it. After the fact, we can all talk about how great we are, but the reality of it is that no industry anywhere in the world has been created without government playing a role. On the flip side, government has not done a particularly good job. They've made a lot of mistakes, and they've invested a lot of money, not all of which are appropriate. But the government rationale really gets down to this. If you really believe that technology and technical innovation spurs economic growth, then and entrepreneurship and venture capital really does and is something that stimulates innovation, then there's definitely a role. When you think about innovation, by definition, is about change. And it's about upending the establishment. It really does have small companies that go up against big companies who are established and are making excess profits in an area that needs to change. And that's what entrepreneurs like you do, and VCs who back you are after exactly what you're trying to do. And government really can promote entrepreneurship and venture capital. to provide support for new companies. And here's some things that I think governments can do. And it's not just about money. They can ensure that creative ideas can move freely from universities and government labs to new companies. I can't stress how important that is and how often we have such great technology inside our universities that just are untapped and unavailable to be created into new companies. We can allow firms to enter into new contracts. In many places, especially in Asia, companies aren't able to enter into the contracts they need in order to support those companies. They can ensure business technology students are exposed to entrepreneurship classes. Now, I recognized with the conversation we had just before with our two professors that it may be taught and may be born, but the reality is that in getting entrepreneurship training to engineers is an important element. The other part of it is, and I won't take away, I know that the world is built by 20-year-olds that are kind of pissed off at the world and want to see a change. But the reality is there are a lot of opportunities. So entrepreneurship training opportunities for mid-career professionals is also something that will make a big difference. The governments can assure that international investors find jurisdiction as an attractive place to which to invest, because really by attracting the international investors is where you take a step back and really see how competitive this is in the global scale. And lastly, if you can target policies and incentives for individuals and institutionals like pension funds, like endowments, to invest in venture capital, that will help create an industry for your area. So those are some of the things that I thought I'd share. Venture capitalists do want to invest. They invest in very few companies, but I'd encourage you to consider if you're a company that has the potential to really seek another form, especially if you're not able to get the bank financing you need. Thank you.
Thank you, Paul. You've given us a lot to think about. Like my other panelists, Vincent Lowe also gave me my orders, and that's to make sure that we have a good dialogue going. I want to make sure I get as many questions as possible from you in the audience in the next 20 minutes or so that we have. Staff are back there with some sheets. You can write your questions down. Please raise your hand or let them know if you have some questions, and I'll try to make sure that we get as many heard as possible. Paul, let me kick this off by asking, you said about 80% of the ventures either fail completely or investors don't get their money back. You also said that the best source of financing is friends, family, and fools. How do you keep friends with your friends after you don't give them their money back? And I mean that quite seriously, because people do go to friends and family. It's got to be an issue.
I don't think I'm. Okay, I don't think I'm saying anything that I think most people who've invested haven't noticed. There are different sectors, though. I mean, when you think about it, if you're investing in a retail shop, it's a lot less risky. If you're investing in a new technology, it's a lot more risky. Especially in today's age, you know that starting a digital media business is a fraction of what it used to cost. So now you don't need to buy all of your computers, you don't need to buy Microsoft Office, you don't have to buy your servers, you don't really need your phone lines. Starting a business has gotten much easier, and there's no shortage of youth today who are starting new digital media businesses. The unfortunate part of that is that because it's so much easier, you probably have tenfold the number of companies that started, and probably 90% of them could have used a little bit more thought and discipline before they started. So it is harder to piece through that. When we invest, our goal is not to have obviously 80% of it not paid back, but the reality is that we are going for the high risk. And we're hoping that in our portfolio, the one or two that actually ends up being the big hit will offset all the losses. Now, we're hoping when we invest always that we're thinking all 10 out of 10 are going to be great. It just doesn't work out that way. No matter how much we spend and how good we think we are, we're going for high risk.
But how about the people who, they're only investing in one, they're investing in their family or their friend, that money's lost. How do the business people keep the friends and family on side and keep that relationship intact?
I think if you talk to most successful business people, they all have stories about how much they sweat it and how hard they work to pay it back. And some of the ones who maybe didn't get successful, they're also planning to somehow, in my next venture, in my next investment, I will make good. And I think that goes through a lot of it. I think what drives the stress level and what really makes the economy go is people are taking risk, and they're taking risks, and they're supported by community.
Yeah. So in some senses, it comes back to the issues that Ben talked about. You've got to have integrity. Your friends and family have to know you're not using the credit cards to go out to Lan Kwai Fong. You're really trying to pay them back and keeping them on side and communicating with them. Ben, we have several questions for you. Let's see. Let's start with sort of a macro issue. The European sovereign debt crisis, the continuing global financial crisis, to what extent has that affected your SME lending, I guess here in Hong Kong specifically and Asia in general, in terms of both lending rate and your willingness to grant loans?
No, Mark, fortunately, it hasn't really impacted us as a bank because we are less impacted by what's happening in the Eurozone, as well as we really never had a huge amount of sub-debt crisis during the U.S. Problems. The issue on the flip side is, what is the Eurozone crisis doing to lending in the European area? Because what's happening is, because of the debt crisis and because of all the new regulations that are being imposed on banks, banks are required to hold more capital. And in that process, chances are they will need to pare their lending. They need to deleverage. And I think the issue is a second-order impact of the European crisis impacting banks in Europe. European banks are not lending as much to their businesses, local domestic economy. Their domestic consumer demand comes down, which indirectly impacts orders in terms of import from this part of the world. This is a second-order impact onto SMEs here. So SMEs in Hong Kong, for example, are suffering from a few problems. One is the orders from Europe has gone down. The margins have come down because of rising labor and raw material prices. And third component is, if the world's banking sector is trying to deleverage, lend less, that takes away liquidity. And that is these are three very, very difficult problems as SMEs have to face. And that's where I alluded to appropriate level of government support at the appropriate time is important.
Yeah. Are you pulling back on your SME loans here in Hong Kong?
No, not quite. Quite the reverse. If I were to look at, well, my disclosed numbers are up till first half. I'm announcing results next week, so you get to know. But as a first half, right?
That was a long time ago.
So you have to wait a week. If I look at the first half, 2011, compared to just before the crisis, which is 2008 first half, I've more than doubled my lending to SME. That is a demonstration of our support and commitment to the SME sectors in Hong Kong.
Yeah. And you mentioned that the Hong Kong government was quite proactive at the beginning of the crisis. Is there room, or can you recommend something specific for them to do now, or is it enough?
Well, obviously we do talk regularly to the government. As a matter of fact, during this particular budget, it did come up with a different plan through the Mortgage Corp, which is through buying SME insurance, hopefully to have a higher level of guarantee to the loans that bank lend. I think there's something in it that SMEs have to pay, something in it for the banks who have to contribute, and something that government also supports. I think these are the kind of partnership and collaboration that economies need to think about, particularly during difficult periods of time.
But we're at a point economically where the crisis is hitting enough that it is time for the government to step up with some more here in Hong Kong.
And I think it is responding, and obviously, as a major bank, it is also my responsibility to feed back to officials, monetary authority, etc., about what's happening. What I see are SMEs behaving? What are their needs? And I have a role to play to meet their needs, but I think where I can't totally fulfill that need, I will need to ask for help as well.
Yeah, yeah. Paul, we have a question for you on areas in Asia that you think, the industries or sectors that you think VC or private equity players would be most interested in.
Well, there's really no shortage. I mean, you got such fantastic growth opportunities here in Asia. And you look at how the world's changing right now, there's a wholesale shift into the mobile space. And so tremendous opportunities. The biggest markets are here in Asia. You know, we've gone from the period of time when you'd buy your phone once every 10 or 20 years to now if your phone is more than 18 months old, it feels really old. So, I mean, what tremendous opportunities that leaves on that side. Plus, you're expecting everything to be connected. You've got things now coming out, which are a huge opportunity with the population of tracking wirelessly everything that and how you live. You know, you have, I think I have one, you know, a Fitbit monitor or something that tells you how many steps you walked, how much oxygen you're using, how much you track what you're eating. These are things that are changing the way we're living and allowing not just, us to be connected, but our bodies to be connected, our TVs to be connected, our phones to be connected. Everything is now starting to be connected, and I think those are tremendous opportunities that are just starting to merge.
Yeah. I have a few more questions for you, Paul, specifically Asia-related. One questioner wanted to know if you're only investing in IT companies, and if not, examples of other areas you're interested in. Also, several questioners are concerned that the level of VC activity in Hong Kong seems to be very low, and wondered if you had any comments on that. And if you were investing in Hong Kong, what kind of numbers, what kind of returns would you like to see, and would it matter if the company were based in the States or in Canada? Would that give you more comfort?
Well, I'll tell you, we invest anywhere in the world. Our focus, though, is as a sector. We invest in digital media only. We think we're something we know a little bit more about, something we think we have advantages in. To be fair, though, I mean, we say digital media only. There's a company in Vancouver that approached us. They do screens within goggles, and we looked at it and said, "Hey, it's hardware. We don't want to invest in that. We don't know anything about it." They came back a year and a half later. They're going to go from $1.5 million to $12 million to $35 million. We said, we're not religious about the hardware part, so we will look at that.
Maybe you'll be using those on the ski slopes near Vancouver. I've saw some people using those. They tell you the incoming phone calls and everything. It's a very interesting technology. Ben, despite your very impressive presentation, we have some skeptical people in the audience who are not convinced that banks are doing enough to cultivate good old-fashioned lending. They want to know what Stan Chart is really doing besides having too many tellers hard-selling financial products. So how can you reconnect finance to the real economy? And then we have a very specific question, anyone or any department that deals with SME loans.
The second part is easy. I just saw a glimpse of my head of SME sitting over there, so you can all direct and his name is Kelvin, so you can just approach him.
Front row on my left.
No, and to be fair, I think banks do have a role to play to channel those with surplus funding, right, depositors, into those who need funds, the borrowers. That is a role that bankers have been playing in the past, probably got a little carried away during the financial crisis. Make no mistake, I think bankers should play a part or accept that they have played a part in the financial crisis. But the fundamental thing is there's a multiply effect phenomenon in terms of if you get the money to flow, that's where you generate positive economic growth through use of money. The world has changed from the standpoint of the need for banks to hold these days a lot more equity, right? And this is, again, post-crisis. Take Standard Chartered example. 3 years ago, my core equity is 6%. Today, I'm holding 12% equity, which means the same business I've just halved my return, right? So banks will also need to make sure that it can remain competitive to be able to return to shareholders. But in that process, the responsibility to support SMEs as a process, to channel those who need funds, those who have funds to those who need funds, is definitely there. And I repeat what I earlier said, my lending to SME doubled during these 3 years. So on average, I'm growing by 30% rather than shrinking. And that perhaps you can always say, I can do more. And I agree, I can do more. But I also need to make sure that I produce adequate return to the overall the corporate and shareholders as well.
Yeah. No, those are impressive figures, and I'm sure we'll all be watching your results next week to see how the SME sector is faring. I have questions for both of you on governance. Let me start with Ben. In terms of governance, apart from separate personal and corporate accounts, what other aspects of governance would you like to highlight when you're looking at SME companies in particular?
How you manage your books, how you have them properly audited, how you have, I would say, proper management to really differentiate between what you do day to day. The smaller you are, the more difficult it is to segregate. And once you become big, then you need to have proper, I would say, governance standards, how you operate, how you do your purchasing, how you do your sourcing, how you sell, whom you sell to. These are all, as a corporate grows bigger, that's the more you need to adopt more higher level standards of corporate governance. At the most, I would say, basic level, I think that very first segregation is a very, very good starting point.
Yeah. And Paul, what about you? Are there specific sort of key points you look at in terms of governance?
We deal with private companies, but I will tell you that we are pretty particular about some of the standard things. We do require, financials. We do require they to be audited. We do require that you have a great controller and that what we're really looking for is not just the management team, but specifically the CEO knows exactly what's going on and has a view on it. And if we think that his team is weak, then we're pretty upfront about it. We're invested in one company in Seattle, and we felt the CFO was weak. The CEO's let him go, and now we've lent a person there for the last month until they can hire someone better. But we will put people in place for a temporary, and our goal is temporary, until they can find someone that can meld with the team. Because reality is, not only does that person has to be great, but it has to mix with the rest of the management team.
Yeah. One skeptical member of the audience wants me to ask you, given the high rate of failure of startups, would you say that venture capitalists are overpaid?
I think you can look at that in two ways. Clearly, when you have a major hit like Excel did with Facebook, and they're going to take home $1 billion or something like that, you could argue that maybe that's a little bit high. But on the flip side, note that the top tier, maybe the top 25%, make pretty good money. But for 60 to 70% of the venture capital, their first fund is also the last one. So if they don't do well for the investors, and a lot of them clearly, based on the last 10 years, haven't done as well as they should and not commensurate with the risk, they're not around much longer. They're no different than the entrepreneurs that they're trying to support.
Yeah. Good. We have about 2 minutes, so let me try to wrap up a few of the questions I haven't gotten to. We've got some questions about social enterprises and whether or not there's a role for either banks or venture capitalists to fund social enterprises. Which I guess begs the question of whether businesses that don't call themselves social enterprises are all socially bad, which I think is not the case at all. A couple questions for Ben about regulations hitting banks and increasing their cost of capital. You alluded to this, but what is going to be the impact on SME financing? And particularly in the UK, if there's ring fencing of banks, will SME financing be hit? And then someone wants to know, in terms of, for both of you, I guess, in terms of business opportunities, some people aren't so good at proposals. Do you take, given this is the modern age, do you take oral or video proposals? So I'll let you sort of answer any or all of those questions and make any concluding remarks, and we'll wrap this up. Ben?
Very quick, social enterprises, yes, we do support them, but social enterprises also need to prove that they are going concern. Right. Period. Right. On the whole about capital, I think the risk, again, everybody wants better regulation, safer banks. There is this unintended consequence of having too stringent requirement on capital, on liquidity, etc., which runs the risk of banks not lending. That is the overarching balance that politicians and heads of state need to strike. Personally, I don't think this balance has been struck appropriately. The world needs growth. And this is what the world is lacking.
So you're worried that the capital requirements and other restrictions are getting to be too much. There's too much of an overreaction.
A lot of European banks are deleveraging. That is a challenge for the overall global economic growth. And this, I think right now, employment and growth is what the world needs. That's probably where I would end.
Okay. Paul?
I'll save the time on the joke, but we do support social enterprises, especially where it leads to better returns, better savings, and better purchase decisions. And there really has been that shift. Most consumers today will, given the choice, all things being equal, support the company that they can identify most with. So that's important in terms of, I'm going to leave the regulatory, but in terms of what can governments do, I think at the end of the day, what really governments can, I think it's hard for governments today to find out how to bridge the gap that's required, but there really is a gap. And what's really going to change what is happening is to try to direct more dollars into the risk areas of the economy and drive innovation. And it is, going to be very difficult for them and for the economy if there is a decrease in lending. To be fair, when there's decrease in lending, it makes our business a little bit easier. But the reality of it is that what drives and leverages our businesses as well is the fact that there's availability of capital. Note that when there is a decrease, it's also harder for us to raise money. And we go to market every 4 or 5 years, and it's difficult to raise money, so it's harder for our business as well.
One last comment. Bankers are also humans. We do have a heart.
Well, Ben, I think that's a nice way to end. Well, let me end by thanking our panelists, but also Vincent Lo and everybody who's been involved with the APEC SME Summit, the Hong Kong TDC staff. But above all, please join me in thanking Ben and Paul for a very thought-provoking session. Thank you.